Alright, what's up everybody, and welcome back to Ruscell AI Investor. It's Jovan here, and today we're diving deep into a topic that I know a lot of you are super interested in: how you, yes you, can grow your stock portfolio to a cool 1 million Jamaican dollars. Now I know that might sound like a massive, maybe even intimidating number, but trust me, with the right strategy, a bit of discipline, and the power of the market, it's absolutely achievable. We're not talking about some get-rich-quick scheme here. We're talking about building real, sustainable wealth step by step right here in Jamaica. So if you're ready to transform your financial future, you're in the right place. The journey to 1 million JMD in the stock market isn't about luck. It's about a solid plan and consistent action. Today, I'm going to break down exactly what you need to do, from figuring out how much to save, to picking the right investments, and most importantly, developing the mindset that will carry you through the inevitable ups and downs. We'll cover the nitty-gritty details, the stuff that actually moves the needle. Think of this video as your personal roadmap. We'll explore how even small, regular investments can balloon into something significant thanks to the magic of compounding. It's all about playing the long game, and I'm here to show you how. Before we jump into the good stuff, if you haven't already, do me a huge favor and smash that subscribe button down below. And don't forget to ring that little notification bell next to it. Why? Because I'm constantly dropping videos just like this one, packed with actionable advice to help you level up your investing game and make your money work harder for you. You won't want to miss out on future insights that could accelerate your journey to that million JMD mark and beyond. Alright, enough talk, let's get into it. Alright, so the first big question on everyone's mind is probably, Jovan, how much do I actually need to invest each month to hit that 1 million JMD target? And that's a fantastic question. Let's break it down. If you're aiming for 1 million JMD in say 5 years, and we assume a pretty reasonable average annual return of, let's call it 8 to 10% from a diversified portfolio, you're looking at investing somewhere in the ballpark of 12,000 to 13,000 JMD per month. Now, if you want to get there faster, say in 3 years, that monthly figure jumps up significantly, probably closer to 23,000 to 25,000 JMD per month. It's a commitment, no doubt, but seeing the numbers makes it real. It's not just a dream, it's a calculation. Now here's where the real magic happens, and it's a concept I talk about all the time. Compounding. This is where your investment earnings start generating their own earnings. It's like a snowball rolling downhill, getting bigger and bigger. Even if those monthly amounts seem a bit daunting right now, understand that every single dollar you invest early on has more time to grow and compound. That 100 JMD you invest today could be worth significantly more in 5, 10, or 20 years. Not just because the stock went up, but because the earnings it generated also started working for you. It's incredibly powerful, and it's why starting sooner, even with less, often beats starting later with more. So the key takeaway here isn't just the raw numbers, but the unwavering power of consistency. Hitting that target is less about finding one miracle stock, and more about the discipline of making regular, planned investments month in and month out, regardless of what the market is doing in the short term. Think about setting up an automatic transfer to your brokerage account right after you get paid. That way, you're paying yourself first, and you're building that investment habit without having to think too much about it. It's about making it a non-negotiable part of your financial routine. This consistent effort, combined with the power of compounding, is what will ultimately get you to that 1 million JMD mark. Okay, so you've figured out your target and you're ready to start investing. The next crucial step is choosing the right platform, your brokerage firm. This is essentially your gateway to the stock market, so you want to make sure you're picking a reliable partner. Here in Jamaica, we have several reputable brokerage firms. Now, I'm not going to endorse any specific one here, because the best one really depends on your individual needs. But you'll want to do your research on firms licensed by the Financial Services Commission, or FSC. Look for brokers with a solid track record, transparent fee structures, because fees can eat into your returns over time, a user-friendly online platform, and decent customer support for when you have questions. When you're comparing brokers, there are a few key things to look out for. How easy is their platform to navigate? Can you easily find the information you need to make investment decisions? Do they offer any research tools or educational resources? Security is also paramount. You want to ensure your money and personal information are safe. Some brokers might offer lower transaction fees, which is great if you plan to trade more actively, though for our long-term strategy, this might be less of a deciding factor than overall reliability and ease of use. Take the time to compare their account opening process, minimum deposit requirements, and the range of investment products they offer. And while our primary focus is building a 1 million JMD portfolio through the Jamaica Stock Exchange, some of you might be curious about international exposure. Some local brokers might offer access to international markets or specific products that give you that diversification. If that's something you're interested in, make sure to ask potential brokers about those options, the associated costs, and any regulations around it. The main thing is to do your due diligence. Read reviews, maybe even talk to current clients if you can, and choose a broker that you feel comfortable with and that aligns with your investment goals. This is a long-term relationship, so choose wisely. Now that you have your broker sorted, let's talk about what you're actually going to invest in. And the most important principle here, something you'll hear me and every other sensible investor talk about, is diversification. You've heard the saying, don't put all your eggs in one basket, and it's incredibly true for investing. Diversification is your #1 tool for managing risk. If you invest all your money in just 1 or 2 companies, and those companies hit a rough patch, your entire portfolio suffers. But if you spread your investments across various companies and even different types of assets, you cushion the blow from any single underperformer. So what does a diversified portfolio look like? We're talking about a balanced mix of different kinds of stocks. First, you have growth stocks. These are shares in companies that are expected to grow at an above-average rate compared to other companies in the market. They usually don't pay high dividends because they're reinvesting their profits back into the business to fuel that growth. They offer the potential for higher returns but can also come with higher risk and volatility. Then you have dividend stocks or income stocks. These are typically more established companies that pay out a portion of their profits to shareholders in the form of dividends. They provide a steady income stream and can be a bit more stable. And finally, you might consider defensive stocks. These are companies in sectors that tend to perform steadily regardless of the overall state of the economy. Think utilities, consumer staples like food and household goods or healthcare. They might not offer explosive growth, but they can provide stability to your portfolio, especially during market downturns. For a balanced approach aiming for that 1 million JMD, a sample allocation might be something like 40% in solid growth stocks, 40% in reliable dividend-paying stocks, and 20% in defensive stocks. Remember, this is just a general guideline. Your ideal allocation will depend on your age, risk tolerance, and specific financial goals. The key is not to be overly concentrated in any one area. Alright, let's talk about one of my favorite topics when it comes to supercharging your portfolio growth, reinvesting your dividends. So, when you own shares in certain companies, especially those dividend stocks we just talked about, they might pay you a portion of their profits, usually quarterly or annually. This payment is called a dividend. Now, you have a choice. You can take that dividend as cash and spend it, or you can do something much smarter, especially when you're in the wealth-building phase. You can reinvest it. Many brokers offer something called a dividend reinvestment plan, or DRIP, which automatically uses your dividend payments to buy more shares of the same stock, sometimes even fractional shares. Why is this so powerful? Because reinvesting dividends creates a compounding effect within your compounding effect. Think about it. Those newly purchased shares will then also be eligible to earn future dividends. So you get dividends, you buy more shares with those dividends. Those new shares then generate even more dividends, which buy even more shares, and on it goes. It's like that snowball we talked about earlier, but now you're actively throwing more snow onto it every time you get a dividend payment. It might seem like small amounts at first, maybe just a few hundred or a couple of thousand JMD, but over years and decades, this process can add tens, even hundreds of thousands of JMD to your portfolio's value without you lifting an extra finger. So, my strong advice, especially when you're working towards that first million JMD, is to always reinvest your dividends. Don't even think about taking them as cash unless you absolutely have to for some emergency. Set up DRIPs where available, or if not, manually use that dividend cash to buy more shares as soon as it hits your account. Consider it free money that's being put back to work to make you even more money. It's one of the most passive yet potent ways to accelerate your journey to your financial goals. It's a simple strategy, but the long-term impact is absolutely massive. Don't underestimate the power of those reinvested dividends. This next point is absolutely crucial, and honestly, it's more about psychology than numbers. You have to stick to a long-term mindset. The stock market, by its very nature, is volatile. There will be good days, good months, and bad months. There will be periods where the market soars, and there will be periods where it dips or even crashes. This is perfectly normal. It's part of the investing journey. The biggest mistake I see new investors make, and even some experienced ones, is panicking during those market dips and selling off their investments, often at a loss. Emotional investing is your enemy. You've probably heard the phrase, "It's not about timing the market, but about time the market." And that couldn't be more true. Trying to predict the market's short-term movements is a fool's errand. Even the professionals get it wrong most of the time. But historically, over the long term, the stock market has always trended upwards. Companies grow, economies expand, and innovation drives progress. By staying invested through the ups and downs, you give your portfolio the chance to recover from downturns and capture those long-term gains. Pulling your money out when things look scary often means you miss the eventual rebound, which can be sharp and swift. So, what do you do when the market takes a tumble and your portfolio value drops? You stick to your plan. You continue making those regular monthly contributions we talked about in Chapter 1. In fact, when prices are lower, your fixed monthly investment actually buys you more shares of those great companies. This is called dollar cost averaging, and it's a powerful way to lower your average purchase price over time. It requires discipline and a bit of courage to invest when everyone else is fearful, but patience is rewarded in the stock market. Keep your eyes on that long-term 1 million Jamaican dollars goal, not on the daily noise of the market. Alright, so you're investing regularly, you're diversified, you're reinvesting dividends, and you're keeping a long-term mindset. Fantastic. But how do you know if you're on track? That's where monitoring your progress comes in. Tracking your portfolio is super important for a few reasons. Firstly, it keeps you motivated. Seeing your portfolio grow, even incrementally, can be a huge psychological boost and reinforce those good investing habits. Secondly, it helps you understand what's working and what's not. Are certain investments performing as expected? Is your overall asset allocation still in line with your goals? And thirdly, it allows you to make informed adjustments if necessary. Now, I'm not saying you need to check your portfolio value 10 times a day. In fact, that can lead to anxiety and emotional decision-making, which we want to avoid. But setting up a system to regularly review your progress, say on a monthly or quarterly basis, is a smart move. One of the simplest ways to do this is with a spreadsheet. You can create columns to track things like the date of investment, the amount invested, the specific stocks or funds purchased, the number of shares, the purchase price, the current market value, any dividends received, and your overall portfolio return. This gives you a clear picture of how your money is growing over time. There are also various apps and online tools that can help you track your portfolio, some of which might even link directly to your brokerage account, automating much of the data entry. Explore what's available and what works best for you. The key is to have a system that allows you to see your total contributions, the current value of your holdings, how much you've earned in dividends, and your overall percentage gain or loss. Reviewing this regularly helps you stay engaged with your financial goals, celebrate milestones, and make sure your journey to 1 million Jamaican dollars is heading in the right direction. It's about being an informed and proactive investor. Finally, and this is a point that I truly believe separates successful long-term investors from the rest, you must commit to continuous learning. The world of investing isn't static. Market conditions change, new investment products emerge, economic landscapes shift, and new opportunities and risks present themselves all the time. What worked well 10 years ago might not be the optimal strategy today. Therefore, consistently educating yourself and sharpening your financial acumen is not just beneficial, it's essential for sustained success, and for protecting and growing that 1 million Jamaican dollars portfolio once you reach it, and then growing it even further. So, how do you keep learning? Well, you're already doing a great job by watching videos like this one. But don't stop here. There's a wealth of information out there. Consider reading classic investment books. Titles like The Intelligent Investor by Benjamin Graham or A Random Walk Down Wall Street by Burton Malkiel are timeless for a reason, offering profound insights into market behavior and investment principles. There might also be books specifically focused on Jamaican finance or Caribbean markets that could provide localized insights. Follow reputable financial news sources, both local and international, to stay informed about economic trends and market developments. The goal isn't to become a Wall Street wizard overnight, but to gradually build your understanding of how markets work, what drives stock prices, and how to analyze potential investments. The more you understand what you're investing in and why, the less likely you are to make fear-based or greed-driven decisions. Continuous learning builds confidence, helps you ask better questions, and empowers you to make smarter choices with your money. Think of it as investing in your greatest asset, yourself, and your ability to manage and grow your wealth effectively over your entire lifetime. It's an ongoing process, but one that pays incredible dividends. So there you have it, a comprehensive step-by-step guide on how to build a 1 million Jamaican dollars stock portfolio right here in Jamaica. We've covered everything from setting your monthly investment targets and understanding the power of compounding, to choosing the right brokerage platform, building a diversified portfolio, the magic of reinvesting dividends, maintaining that crucial long-term mindset, tracking your progress diligently, and finally, the importance of continuous learning. It might seem like a lot, but each step is manageable and incredibly powerful when combined. Reaching that million Jamaican dollars mark isn't a far-fetched dream. It's a tangible goal that you can achieve with a solid plan, consistent effort, and discipline. The most important thing you can do after watching this video is to take that first step, seriously. Whether it's opening a brokerage account, setting up that first automatic transfer, or just committing to saving an extra 1,000 Jamaican dollars this month to invest, start somewhere. The journey to $1 million Jamaican dollars, like any great journey, begins with that single decisive action. Don't let analysis paralysis hold you back. You have the blueprint now, it's time to start building. Remember, the best time to plant a tree was 20 years ago. The second best time is today. Let today be your day. Thank you so much for sticking with me through this entire video. I truly hope you found it valuable and that it's given you the clarity and motivation to start or accelerate your investment journey. If you got something out of this, please give the video a big thumbs up, it really helps the channel out. And I'd love to hear from you. What's the biggest takeaway for you from today's video? Or what's the first step you're going to take? Drop a comment down below, I read them all. Don't forget to share this with anyone you know who could benefit from this information. Until next time, keep investing wisely and I'll see you in the next video.